Johnson & Johnson, stock ticker J&J, just released their latest quarter's earnings report, and we saw a nice jump up in the share price over the past few days due to that. So in this video, we're going to be looking at the latest quarter's earnings, going over a few updates with the stock, and also jumping into my stock valuation spreadsheet to see if it's trading at a good value. So let's go ahead and dig into it. Now, when you think of Johnson & Johnson stock, there's a lot to like about the company. Now, obviously, the huge appeal for most people is that dividend history. This is a company that's increased dividend payouts for 60 consecutive years. Anytime you have a company that has that incredible of a dividend history, there's a couple of different things you can assume about the company. You can't assume management has a strong capital allocation plan. They have really strong and growing free cash flow, and they also have some competitive advantages. So if we zoom out and look all the way back starting in 1990, which they have been increasing dividends even before that, but that dividend growth chart is a thing of beauty. If we look at the 10-year chart, we can see 10 years ago, they were paying out 61 cents per share every single quarter. Jump forward to now, it is now sitting at $1.19 per share. Scroll up a little bit and look at those dividend growth rates, and for a company that's increased dividends for that long, they actually have increased dividends by a decent amount over the past 3, 5, and 10 years. You can see we have pretty much around a 6% dividend growth rate for each of those time periods, so that's pretty consistent dividend growth. Now let's look at just the past 5 days, because they did just announce their latest quarter's earnings, and you can see we saw a spike up of 7.41% in just the past 5 days. Now if we zoom out and look at them year to date, they're actually still down about 4.5% despite this recent jump up. But let's go ahead and jump into the latest quarter's earnings. We'll jump over here and you can see Johnson & Johnson beat on their earnings per share expectations by 18 cents, and they also beat on their revenue expectations by $860 million. And in other news, we also saw that Johnson & Johnson does intend to split off Kenvue shares through an exchange offer as the form of its next step in the separation, subject to market conditions. And they did talk about this a little bit in the most recent quarter's earnings. If we scroll down, we saw that this could happen as early in the coming days. Now, in other news with Johnson & Johnson stock, they are still battling some lawsuits, and we can see they did recently have to pay $18.8 million over baby powder cancer claim, the jury ruled. Now, for a company the size of Johnson & Johnson, $18.8 million really isn't anything, but that does have the potential to be a larger number in the future. But Johnson & Johnson is fighting back against these litigation claims. You can see Johnson & Johnson sues researchers who wrote talc powder linked to cancer. So while this company has existed for a very long time, there's definitely no shortage of information going on with the company right now. But despite all of this, they're still one of the highest credit rating companies in the entire United States. There's only 2 companies with a AAA credit rating, with Microsoft being one of them, but Johnson & Johnson is the other one. So that's very impressive. And again, that's one of the reasons this company typically trades at a premium, as we'll see in a minute with the valuations. But let's go ahead and jump over to my stock valuation spreadsheet to see if we can find the intrinsic value of Johnson & Johnson and decide if it's a stock we should be buying or selling. We'll be looking at a few different valuation models like always, so if you'd like to be able to download the spreadsheet, you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and plug in J&J and hit enter, and you can see all of this data will automatically load in. Now the current dividend yield with this company is sitting at around 2.8%, so not a bad starting dividend yield, but not super high either. Now the payout ratio here is sitting at around 65.10%. Let's go ahead and dig into that just a little bit more. We'll jump back over to Seeking Alpha, click on dividends and dividend safety. If I scroll down, one thing that I like to look at is the cash flow payout ratio, and this is the forward-looking cash flow payout ratio, and it's currently sitting at around 40.41%. To me, I think that is a very healthy level for Johnson & Johnson's cash flow payout to be at. With a company that's been increasing dividends for this long, that's a really impressive metric, really. I would have expected to see it higher, so that's definitely a good sign. If we come down here, we can see analysts currently have a target price of around $182 per share, institutional ownership around 71%, and a beta of just 0.55, so you should see very, very little volatility with this company. Now, the first valuation model that I typically like to look at is Graham's valuation. Now, I actually don't think this is the best valuation model in this scenario for Johnson & Johnson, so we're actually not going to be using it, but basically what you do is you use the earnings per share, multiply your growth rate projection, multiply that by 4.4, which is the average yield on AAA corporate bonds, and divide by Y, which is the current yield on AAA corporate bonds, and it'll spit out your intrinsic value according to Graham's valuation. But again, I don't think this provides a fair valuation in Johnson & Johnson's case. I think the best valuations for them are going to be the discounted cash flow analysis and the dividend discount model. Let's go ahead and look at our DCF model to start. you can see here basically what I've done is I plugged in the historical free cash flow for this company so we can see our year-over-year free cash flow growth rates. I'm currently projecting a free cash flow growth rate of 5.5% moving forward, but for the next year in 2023, I'm projecting free cash flow a little bit higher than the 5.5% growth rate. I think it'll be a little bit higher than their 2020 and 2021 free cash flow. So I'm taking that 5.5% growth rate and projecting it to after 2023. After I've done that, I found the present value of all of those future free cash flows and added them together, add the company's cash and cash equivalents, subtracted out the total debt to get their equity value, divided by shares outstanding, and I came to a discounted cash flow price per share of $160.34. Now, the next valuation model I usually look at is the multiples valuation, but let me tell you why I don't think this is the best valuation model for Johnson & Johnson. In terms of safety and quality, Johnson & Johnson is head and shoulders better than all of their competitors, whether it be AbbVie, MRK, or Pfizer. Like I already mentioned, they have a AAA credit rating and have been increasing dividends for 60 consecutive years. Investors can know what to expect when they invest in this company. They're getting slow but growing and very stable dividends, so they feel very comfortable holding this company, especially in a downward market. Due to all of that, Johnson & Johnson is typically going to have a higher price to earnings multiple, which in the multiples valuation model would lead to a lower valuation, but I really don't think it provides a fair valuation in this scenario due to those facts in that Johnson & Johnson trades at a premium. So the last valuation model we'll look at is the dividend discount model. This is basically a way to value a company based on how much they pay out in dividends and how much that dividend is increasing over time. So what I've done is I plugged in the quarterly dividend payouts historically so we can see those year-over-year dividend payouts. Now we can see the year-over-year dividend growth rates, and we have 5.5, 6.3, around 5%, and 6.6. That's an average growth rate of around 5.86. So moving forward, I'm projecting a dividend growth rate of 5.25, discount rate of 8, and that gives us a dividend discount model price per share of $173. Now, I think a dividend growth rate of 5.25% is sustainable for this company for a few different reasons. We are expecting pretty decent growing free cash flow, and the payout ratio that we already saw earlier, especially the cash flow payout ratio, appears to be pretty safe. So I do think this will be sustainable. So when we jump over to our output tab, we have our two valuations, our DCF and our dividend discount model. When we average both of these together, we come to an intrinsic value of around $166.67 per share. The current trading price for this company is sitting at around $170, so it's only a 2% difference. With a 10% margin of safety, you can see our acceptable buy price for this company currently sitting at around $150 per share. Now, the thing about companies like Johnson & Johnson or Apple or Microsoft, these companies almost always trade at a premium, so rarely are you able to apply a large margin of safety and buy in at that acceptable buy price. For example, my average buy price for Johnson & Johnson is actually around $162 or $163 per share. If I blow this up just a little bit, you can see it currently makes up around 3% of my entire dividend portfolio, and I have seen a little bit of growth from this position. If we come down here, you can see I'm currently up around 5.5% on this position, which is decent. But I also haven't had this position out for very long, and I'm also investing for long-term returns. I know I can trust Johnson & Johnson to continue to grow their free cash flow year after year, and in turn increase their dividend payouts year after year. And if we jump back over to Seeking Alpha, you will also see that there have definitely been opportunities within the past year or so to buy in at pretty decent prices. It looks like its 52-week low is actually right at $150 per share. So in that case, you actually would have been able to apply your 10% margin of safety. As for me, I don't currently plan on adding more shares at its current prices, but anytime it starts to drop down to around that 150 to 155 range, I definitely dig into it a little bit more and see if I want to add more. But there you go. There's a quick analysis on Johnson & Johnson. Go ahead and let me know what you think of this stock down in the comments down below. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.